What's up, everybody? Gen X Dividend Investor here. In this episode, I'm excited to share a new milestone, my latest weekly and annual dividend record. I'll also show you a new study that was just published, which found that the 4% retirement rule is based on some questionable data, and that unfortunately, some people who followed it would have run out of money in just 20 years, which to me further makes the case for a dividend strategy rather than one where you're selling your shares for income. Of course, nothing is risk-free, including my dividend approach, but at least I'm not worried about running out of money before I die, which is the number one fear most retirees have. Finally, I'll end this by sharing an inspiring true story about a self-proclaimed below-average guy who broke all the financial rules but navigated his way to success, both monetarily and, even more importantly, to happiness. Let's start by jumping into Fidelity, but remember, it's easy to look at someone else's portfolio and feel behind or inadequate or whatever, but comparison is a thief of joy. So take inspiration if it helps, but never feel like you have to measure yourself against someone else's chapter 20 when you're in a completely different book and on chapter 2 or whatever. Okay, I took this screenshot on Monday, May 18th after market closed, and you can see that my portfolio adds up to $3.27 million US. My quick background is that I'm self-made, never been given a dime nor inherited anything, and have been investing since I got my first real job after college, which was over 30 years ago. The account on top is my retirement IRA, and it's at $1.4 million, and was slowly built up by mostly small contributions from me, along with sometimes getting an employee match when I had 401ks. I almost never maxed my contributions until the end of my career, and for the most of it I was just doing 5% or whatever of my salary, so it's a great example of how powerful compounding becomes over time, and I believe that a lot of people can do well in the market if they just start investing in decent stuff and don't quit when markets crash. And by decent stuff, I usually mean things like VU or VTI, even though I personally focus on SP 500 dividend stocks. My second account listed here is my taxable, and I have about 1.64 million worth of dividend tickers in it. And finally, the third account is my wife's rollover retirement account that I manage, and it has about 209 grand in it. I've sorted my tickers alphabetically in this Fidelity screenshot, and you'll notice that I have some of the same tickers in multiple accounts. Like I only have Apple in my taxable account, but I have AbbVie in all three. On the far right-hand column, we see Fidelity's estimates for how much each ticker will generate in annual dividend income. I'm currently spending about 90+% of that dividend income, but I reinvest a small portion of it back into the ETFs I own. And since I'm still many years away from retirement age, that means I'm paying the early withdrawal penalty on any retirement dividends I pull out. Instead of going over each position right now, I'll do that a bit later in my spreadsheet tool, as that lets you see my total share counts per ticker more easily. And for reference, here's the second of 3 pages of tickers. And finally, this is my third page. You can see in total they add up to $3.27 million, and Fidelity estimates they generate about 138 grand a year. My spreadsheet is more conservative, and it estimates that I'll make $136,000 of divvies per year. Basically, it dynamically updates for changing currency conditions and has a different estimate for go-forward ETF income. But whether it's $136K or $138K a year, it's all more than my family's expenses. And it's pretty darn cool when my divvies pay my mortgage each month, because that means they're also helping me build real estate equity, so I guess you could say that they're dripping into my loan. Now let's look at my total returns as compared to the market for the 4.5 years that I've been at Fidelity. So on the top is a chart I pulled from Seeking Alpha, where I'm an affiliate, and it shows that the total US stock market represented as VTI has returned 51%, and the SP 500 has returned 62% in the time frame in question. On the bottom is a screenshot of what Fidelity says my total returns have been since I moved there, which is 57%. That means I've outperformed the overall market in VTI, but underperformed the SP 500. In my last portfolio update video, I was outperforming the SP 500, but that's before the stock market came roaring back. My portfolio tends to lose less in down markets, so I often do better in those climates, but then I also tend to gain less in up markets. Either way, I'm surprised to be beating the overall market given my diverse portfolio of defensive dividend stocks along with some income ETFs. Granted, it's only 4.5 years, but still, if I had guessed, I would have said I'd be doing worse. Anyway, now let's take a look at my weekly dividend record I just got. And for reference, my old weekly dividend record was $6,900. This is a screenshot of dividends I got last week from Monday, May 12th through Friday, May 16th. This shows that in May 12th in my IRA, I got a BTI dividend for $143. In my taxable, I got a BTI dividend for $2,092, and in my rollover, I got a BTI dividend for $26. Then on May 14th in my taxable, I got a return of capital distribution from Enterprise Products Partners, my MLP, for $2,559, which means tax-free. In my taxable, I got an AbbVie dividend for $682, an AbbVie dividend in my rollover for $441, an Apple dividend in my taxable for $106, an O dividend in my rollover for about $200, a Colgate-Palmolive dividend in my taxable for $212, a Procter & Gamble dividend in my taxable for $328, a $405 AbbVie dividend in my IRA, a $34 O dividend in my taxable, $134 Colgate-Palmolive dividend in my IRA, a $485 PG dividend in my IRA, and finally a $785 O dividend in my IRA. In total, that means I got about $8,600 of divvies in 1 week, blowing away my old weekly record of $6,900. Nice. Okay, now let's take a look at my sum total of tickers in my spreadsheet tool. There's a minor difference between this and what Fidelity shows because Chevron's X date is tomorrow for me when I took the screenshot, and Fidelity is already reflecting that impact, whereas my spreadsheet will show it tomorrow once it happens. I have this sorted by largest positions first, and in this case we see it's Altria. I never thought I'd see Altria as my number one position, but I also didn't expect it to shoot up so much. I mean, it's gone up about 50% in 15 months versus 18% for the SP 500. You can see I have 3,799 shares of MO, and now it's 6.8% of my portfolio, and I have 223 grand of it, which yields $15,500 in divvies per year. I expect them to announce a dividend hike probably in August, so if we guess that they do a 4% hike, then that will take me to 16,120 of MO divvies a year, an increase of $620 a year, or about another $155 a quarterly payout. Next up is SCHD, a dividend ETF, followed by O, a REIT that pays monthly. O currently pays me $1,019 each month in divvies, and that's my wife's favorite stock. Long term, I think O will do well, though they've been in a tough climate for a while. Following them, I own AbbVie, which has also outperformed my expectations. Next up, I own Microsoft, which isn't a classic dividend stock, but has been one of my favorite long-term stocks when it comes to total returns. Then we have EPD, and then Devo, an income ETF. Then J&J, which has been struggling with the various lawsuits against it, followed by JEPQ, another income ETF. I bought my income ETFs with profits of my dividend stocks I partially sold out of. Then I have McDonald's, ExxonMobil, Procter & Gamble, Duke Energy, PTI, Coca-Cola, Philip Morris, Goldman Sachs, Pepsi, which has also been struggling, Southern Company, Apple, Kimberly-Clark, Caterpillar, Chevron, Colgate-Palmolive, Travelers Insurance, Home Depot, IDVO, which is an international version of Devo, and finally Starbucks. In total, I have about 43,600 shares of tickers at a total value of about 3.27 million US bucks. You can see my spreadsheet estimates that my annual dividend distribution income is at $136K and that my portfolio's average weighted starting yield is at 4.16% and my portfolio's average weighted dividend CAGR is at 5.47%. Yes, I could always move some lower yield stuff into higher yield stuff to amp up my income more, but I like how things are right now given my needs, goals, and risk tolerances. Note the coloring of tickers is just a visual way to quickly tell me when divvies will pay out. Okay, and this is a screenshot in my spreadsheet tool called my dividend calendar view. So the middle green column is the month we're currently in, which is May. The columns to the left are dividends I've gotten in the prior 5 months, and to the right are the ones I should get in the future. So like in November of 2024, Realty Income paid me $1,000, then in December I got another $1,000 from them, then in January of 2025 I got $1,002 because they did a tiny raise. Again in February I got $1,002, then in March I got $1,017 because they did a slightly larger raise. Then in April I got $1,019 because they did another small hike. Then this month in May I got $1,019 again from them. Realty Income is known for doing multiple small hikes over the year. And on the bottom of the screen you can see how my total monthly dividend income has been trending. So I got $10,800 in November of 2024, then I got 13.1K, then 9.5, then 10.8, 13.2, 9.5, and then 11.4K this month. Then it's estimated to be 11.4, 11.5, 11.1, 13.5, and 9.4K, all assuming no more dividend hikes, which I'm sure I'll actually get. And then this is my dividend income over time since I created this new spreadsheet tool. So you can see where I was back in January of 2020 versus how things have been trending up. If I wasn't spending almost all of my dividends, then this income would obviously be growing faster, but the free time and early retirement they've given me have been so worth it that I won't complain. And even with me spending them, they're still trending up faster than inflation, which means my buying power keeps getting better. That's part of why I love investing in good dividend stocks so much. I mean, not only do shares tend to go up, but my income also tends to go up, and all that while I'm maintaining or increasing my percent ownership of my companies. Compare that to the classic 4% retirement rule, which is a guideline used to estimate how much a retiree can safely withdraw from their retirement accounts each year without running out of money for at least 30 years. Specifically in your first year of retirement, you withdraw 4% of your total retirement portfolio, which means you sell 4%ish. In each subsequent year, you adjust that initial amount for inflation. So like if you retire with $1 million worth of stocks and cash and such, then in the first year you withdraw 4% of $1 million, which is 40 grand. In the second year, if inflation is 2%, you would withdraw 40 grand plus 2%, which equals $40,800. And then you go from there. Now, the 4% rule assumes you have a balanced portfolio of 50% stocks and 50% bonds, and that historical US market conditions roughly continue. It also assumes that that'll work for at least 30 years, which should cover most people in retirement who quit at age 62. Of course, a 4% withdrawal rate may be too conservative or too aggressive, depending on actual market performance, your longevity, inflation, healthcare costs, etc. And it doesn't account for flexibility, as real retirees often adjust spending. The 4% rule came out in the 1990s, and since then has been a staple recommendation of financial analysts on how you should plan your retirement. And the folks who sell their stocks for income often follow that 4% rule. But this year, a new study just came out that found that the 4% retirement rule is based on some questionable data and assumptions, and that unfortunately, some people who followed it would have run out of money in just 20 years, which to me further makes the case for a dividend strategy, rather than one where you're selling your stock assets for income. The study is called How the 4% Rule Would Have Failed in the 1960s, Reflections on the Folly of Fixed Rate Withdrawals, and the author argues that the 4% rule was based on a limited data set that overlooks certain periods. He contends that the rule can lead to retirees running out of money, especially when high inflation and poor market returns occur early in retirement. So let that sink in for a moment. I mean, the number one fear retirees have is running out of money before they die, a fear even bigger than death itself, and yet now we find out that the classic retirement approach of selling 4% of your assets each year might be less robust than originally thought, exposing some people to what they fear the most while they're their oldest. What this new study suggests instead is taking a more flexible approach to retirement withdrawals. Rather than sticking to a strict fixed percentage each year, retirees should consider adjusting their withdrawal rates based on how the market is doing and what's going on in their personal lives. That kind of adaptive strategy can help reduce the risk that come with market ups and downs or in inflation, making your retirement income more likely to last. Regardless, my guess is that the 4% rule will still work in many situations, but it's not surprising that it might fall short in others. I mean, it was developed based on historical stock and bond returns from 1926 to 1976. And since it was published, various financial experts have come out and suggested the rule should have been 3%, but then we also have those saying 5% could work. Another important point to consider is that when the 4% rule was first developed, life expectancies were shorter than they are today. Combine that with the probable reality that AI will drive material improvements in lifespan, all leading to an even greater risk of outliving your investments in retirement if you're selling stock for income. And if you're thinking the chances of experiencing another prolonged period of poor market performance are low because we only had one lost decade from 2000 to 2013, it's worth knowing that similar downturns occurred from 1966 to 1982 and from 1929 to 1954. Like, check out this performance on the Dow over time, and I'll put this in log scale. We start in the early 1900s and things are trending up. But then the Great Depression hit us in 1929 and the market tanks. We don't get back to that 1929 high until 25 years later in 1954. Ouch. Then we trend up again until 1966, but then we effectively go sideways for 16 years until 1982. Ouch again. Those are the types of bad markets that make it harder for the 4% rule to work, and my point is that we've had multiple really tough periods in the market in the past, and we'll no doubt have more of them in the future. And if you couple a bad market with high inflation, then the 4% rule can flounder, especially if all that happens early in retirement. This is also true in places outside the US, like we saw in Japan's high inflation and weak market in the 1990s. So imagine following that 4% rule where you're selling off your portfolio, and you're continually selling even more of your stocks than you did the previous year due to increasing inflation. And since you might be in a crappy market, then you're selling an even higher percentage of your shares due to them having crashed, and you're still trying to generate enough cash to get to your original 4% amount from the previous year, modified by inflation, and bottom line, you see your portfolio just bleeding down. Now, the failures the study found were from retirees in the 1960s, and they were using mutual funds back then, so the study also did some tests starting in the year 2000 using index funds and treasuries and such, and they tended to last the 30 plus years that were needed. Of course, this study could have its own mistakes, but it's pretty obvious to me that weak markets and high inflation wrecks many portfolios that are selling shares, and the weaker the stock market gains are, the more likely that dividends are some or even all of your returns. So all of that reaffirms my belief that using good dividend stocks in retirement is a much more sustainable and less stressful way to retire. Hopefully that all makes sense. Moving on, now I want to share an inspiring and remarkable true story about a self-proclaimed below-average guy who broke all the financial rules but navigated his way to success, both monetarily and even more importantly, to happiness. Specifically, I'm talking about a 29-year-old who was working at a tire company in Oregon for over a decade, hating his life due to the job and the stresses and the repetitive nature of having a 9-to-5 you don't like. This dude also unfortunately has a spinal disorder that could leave him paralyzed at any moment, and so because of all that, he decided he was going to make a drastic change. He heard about people who sailed from California to Hawaii, and he decided that was the life for him. So he quit his job despite having no savings and having $10,000 in debt. To stay afloat, he liquidated his 401k and began teaching himself to sail by watching YouTube videos. He moved to the Oregon coast and bought a $50,000 sailboat and began slowly fixing it up as he learned what to do. For an entire year, he devoted himself 7 days a week, 12 hours a day, to learning how to sail, as well as some of the basics of being a diesel mechanic, a plumber, an electrician, and a navigator. Basically, he was acquiring all the skills necessary to turn his dream of sailing the ocean into a safer reality. He finally started his Hawaii voyage on April 30th, about 3 weeks ago, and right now he's on day 19 of his trip and is scheduled to get there on May 24th, which is pretty amazing because this is the first time he's ever sailed on the ocean. You can follow him on Instagram, and his ID is called Sailing with Phoenix, which is the name of his rescued cat that he took along with him in his trip. Take a gander at this 1 minute and 40-second clip, and I think you'll see why I find this so inspiring.
This is day 9, sailing across the Pacific Ocean, alone with my cat, from Oregon to Hawaii. I wanted to make this video just to say thank you, everybody. Everything has been so positive, and it's been an incredible thing. I get like emotional, honestly, sometimes talking about it, because I went all in. I went all in on everything. Every single corner of my life, I neglected everything, because all I did was work on this boat, learn how to sail, and post on social media. Those are the three. I didn't even eat food. I had rice and beans every single day to save money. I went all in on everything. I've gone. I'm no stranger to going weeks without a shower, because I just went all in, man. I went all in, and it worked. It worked. I'm in the middle of the ocean, on my boat. Anything is possible. I am the example to that, because I am so below average. You're below average. There is nothing. I can't speak in front of 5 people without my voice cracking. And I'm not smart, all right? I'm not saying that to like be self-deprecating. You see what I mean? I'm not being hard on myself. I'm being real. Like I'm not some crazy smart guy. I'm not some super social person. I have always been a odd duck. Anybody who knows me knows that. And there's nothing special about me. Other than one day I decided, I just went for it, man. I went for it and I put everything into it, and it worked.
Amazing, and I gotta say, the dude has larger cojones than I have. Now sure, he's dealt with bouts of seasickness, and yes, he's literally risking his life, which can't be undersold, but he's also happier than he's ever been. And yes, the cat is fine and appears to love the sailboat, though I'm wondering where all the litter is. Anyway, he seems to understand the extreme risk he's taking. But from his perspective, he could wake up paralyzed any day, whether he's stuck in the rat race he despises or out at sea marveling at dolphins as the sun sets around him. So he figures he might as well be doing something he loves. And in case you're wondering, he's using Starlink to be able to upload videos, and he has things like a satellite phone and various emergency systems in place, but it still is obviously extremely risky. I mean, one day his rudder broke down and he was kind of floundering around trying to figure out what to do, and of course he's had some monstrous waves he's navigated through, not to mention sharks and blah blah blah. What's awesome is that his story has blown up on social media, so he now has like 1.5 million followers, which now means he can generate income without needing to get a 9 to 5. Maybe I should ping him and suggest he start investing in quality dividend stocks. What do you think? Anyway, I'm happy that this guy can continue his passion of sailing around the world with his cat, and I hope he does so safely. Maybe Netflix should talk to Johnny Depp about playing him in a movie, because they both kind of give me the same vibes. It's pretty inspiring to see someone have a dream and push to achieve it against all odds, and then come out even better than they imagined. It hopefully shows you that you aren't ever truly stuck in your current situation. You can change things. Yes, there are risks, but with risks can come rewards. So what do you guys think? Drop a comment and let me know, are you feeling inspired? Or do you think he's a little bit delusional, but you're still rooting for him like I am? Do you think that cashing out your 401k and quitting your job is really worth the risk? I mean, it worked out for this guy, but what do you think? Ironically, he feels that his medical condition may have actually saved his life, because if not for it, then he might never have taken the bold risk of selling everything and buying a boat. Whatever your take is, I ask you to kindly do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Now I'd like to shout out my newest Patreon aristocrat, so thanks Az, who just signed up for an entire year. I'd also like to shout out Giovanni, who also signed up for a year. Patreon aristocrats get access to my dividend spreadsheet tool, as well as they get to watch my videos before I release them publicly, and they get to vote on which thumbnail I use in my videos. Plus they get to hear about my buys or sells before anyone else does. And as a way to show my gratitude to people who leave really nice comments, I'm going to shout out 10 subscribers who've done just that. And note these are from over a year ago before I was calling anybody out. So thank yous go out to Better You Know, Bob Saget 8761, Caddy 1A, Konstantin Sigoyanu 8944, Daniel Williams 6408, John Riley 6565, Joseph Awad 3493, Learning to Invest Easily, Silver Lining 1379, and Xavier Last 3831. Thanks folks, I really appreciate it. Now I'd like to pitch a few quick things, starting off with my FastGraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment even if they sign up for a full year. Also check out my Seeking Alpha affiliate link, as new users often get benefits for signing up. Finally, please check out my Patreon page and or consider joining my channel membership, as both have some cool perks you might like. I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 85 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.